Good morning. Welcome to my YouTube lecture series for Intermediate Financial Accounting 2. I also call it FA3. We're going to take a look at deferred taxes carry forward, carry backwards this morning. And you've had a chance to look at Sneezy Corporation. What I'm hoping to do is walk you through how to solve this problem and clear up any questions or concerns that you may have. There's one real tricky area in this solution question that I really want to emphasize that you understand when you are working through these problems, and then hopefully when you are in the quiz or in the final you'll get 100%. That's always our goal. So let's take a look at it. We'll start with the journal entries. The first one's 2015. Positive year, income-wise, tax rate's 35%. Very straightforward entry. Let's start right there. So in 2015 we've got current income tax expense, and that's going to be based on $220,000 times 35%. That's our tax rate for the year. That's our income for the year. That's equal to $77,000. So $77,000 current income tax expense, current income tax payable, $77,000. Now, 2016, things changed for the company. We have a big loss, $800,000. So what do you do with losses? So as I've talked about in class, losses can be carried back 3 years or carried forward for 20 years. Now let's talk about carrying it back first. You can carry it back to 2013, 14, and 15. Well, in this case, you would carry it back to all 3 years because your loss in 2016 is that significant. But I want to have a little teaching moment with you right now. If you take a look at the question carefully, 2015 is the year you paid the highest amount of taxes on as per the tax rate. So a very aggressive company would say, let's go back and reclaim the amounts that we paid the highest tax on. Another angle that a company could look at is let's go back and get the oldest, the 3 years, because that's the one that's going to expire soon. That's the one that's going to expire first. So a couple different methods here to always keep in mind when you're going back and reclaiming some of these taxes paid. So keep that in mind. We can go back and we may want to claim the one where we paid the highest tax rate. We may go back and we want to claim the one that's going to expire first. So keep that in mind for future questions you look at. There's a little strategy there. Now in this question, we can go back and we can claim all 3 of those years because our loss in 2016 is that significant. Now the key thing to note in this 2016 entry is that we have to use the tax rates that were applicable for each of those years. We're going back and we're getting the amount of taxes we actually paid. So in 2013, that's $140,000 times 30%. It's equal to $42,000. 2014, it's $420,000 times 33%, $138,600. 2015, it's $220,000 times 35%. That's $77,000. In total, that's $257,600. Now the key thing with this entry is that this is a receivable. Make sure you debit receivable here. So this is current income tax refund receivable. $257,600, and then a current income tax benefit. And remember, my simple rule is that if you have anything on the income statement side that's a credit, call it a benefit. Anything that's on the debit side related to this topic, call it an expense. Pretty simple, easy way to remember it. Now, we're not done with this entry, because when we go back and we take a look at all the losses that we had, what we notice is that this adds up to $780,000. Well, we had a loss of 800,000. So we went and we reclaimed 780,000. We had a loss of 800,000. So what we have is a loss of 20,000 still. Now the question is, what do we do with this? Now, as I talked about in class, if it's more likely than not, and I want you to underline that in the question if you see it, if you see those words, more likely than not that the company will be profitable in the future, we can recognize this as a deferred, or also known as a future asset for us, because this loss will allow us to reduce our taxes in the future. Now, we see those words in this question. We see that it's more likely than not to be recognized in the future, so we can set it up as an asset and as a deferred asset. So that's the first thing. This is not current. This is deferred. It's really important that you call it deferred. Now, the second thing I want to get to, and this is the part where most students will lose the marks, is that this is in the future. If you know the future tax rates, you set it up using the future rates. And this is by far the most common mistake. Students will use 38%, which is the tax rate in 2016. Wrong. You use the future rate, which is 37%. That's key. So it's 20,000 times 37%. Again, it's the future rate. Then this is a deferred entry. So we set this up then equal to $7,400. So our entry is deferred tax asset. Again, this is an asset because it'll allow us to reduce our taxes. This is deferred because it happens in the future. $7,400. It's set up at the future rate, not the current. And then deferred tax benefit, $7,400. Now in 2017, another bad year. Imagine this is oil and gas, and the price of oil has gone from $100 down to $45. You can see how companies could have all of a sudden some bad years if the commodity price of oil takes that big of a hit. Now, 2017, we've got another $450,000 loss. Again, what is the future tax rate? 37%. So that's equal to $166,500. And again, more likely than not, we're going to have this ability to recognize this loss in the future. We're an established company. We've had a couple bad years, but historically, we have done really well, so it's more likely than not we will be profitable again in the future. This requires professional judgment. If it's a brand new startup tech company, you probably can't recognize this as an asset. So it probably is not likely you'll be profitable for a while. But most of the time, most companies, they have established profitability history. Therefore, we can recognize this as a deferred asset. So what we're going to do, we're just going to grow that deferred asset account by $166,500. Again, this is deferred tax. Do not call it current. So deferred tax asset, again, make sure you call it an asset. $166,500. Deferred tax benefit, $166,500. Now, 2018 happens. Yay, we're finally profitable again. And we're profitable for $40,000. So 40,000 times 37%, that's equal to 14,800. Now the key thing to recognize here is that even though this is a current amount, we have previous years of losses. So our previous years of losses are going to allow us to basically pay no taxes this year. We're going to go back and get those assets that we set up, use them so we can preserve our cash and pay no taxes. So that's exactly what we're going to do. So we're going to go back and we're going to use up some of our assets. So this time it's called deferred tax expense. $14,800, and deferred tax asset. There is us using our assets up to preserve our cash and pay no taxes. Now what we want to do is take a look at our final year, 2019. 2019, nice positive $500,000. Awesome. That's exactly what we want. We want to make money. So when we look at this, we sit back and say, well, what do we have to pay in taxes? Well, what we have to recognize is, what did we set up in our previous years? What have we basically used up? Well, let's take a look at this. We had $20,000 left over right here, and we had $450,000 set up there. So we started with $20,000 that was related to 2016. We had $450,000 related to 2017. Now, in 2018, we had that profit. We had that profit of $40,000. So what we have left over is $430,000 worth of a loss. So let's use that first. So we have $430,000 times 37%. That's equal to $159,100. This will take the deferred tax asset balance down to zero. And if you do a T account, you will see that. So we're going to use all our asset up so that we don't have to pay as much taxes this year. So deferred tax expense, $159,100. Deferred tax asset, same thing, $159,100. Now, we used $430,000, but we had a profit of $500,000. So we now have to take into consideration, little typo, 19. We now have to take into consideration the fact that we still have to pay some taxes this year. We had a $500,000 income. We were able to use previous year's losses of $430,000. That means that we have $70,000 left over. $70,000 times 37% means that we've got $25,900 for our current income tax expense amount. So our entry will be current income tax expense, $25,900. Current income tax payable, $25,900. So again, key thing to recognize is that when you are setting up your deferred asset, use those rates that are in the future. Don't use the current rate. That's the most common mistake in this question. Anyways, hoping to see a whole bunch of 100% papers. Thank you.